yesterday, Glenn and I talked about IRD income, and basically that's just income with respect to the decedent. So if you're one of those people who, and you hear Dan talk about this a lot, and so many partners are trying to reduce the balance in their qualified accounts because they want to pay the taxes now while they're lower. So here's kind of some backup data for that strategy. If you look from 1979 to 2018, there were only 3 years where tax rates for middle America, the majority, the biggest section of the U.S. population, where they were lower than where they are right now. So in 2018, of course, we had those Trump tax cuts that came into play there. And so now we're at some very, very historically low tax rates. So what a lot of people have been doing, a lot of people got really, really overweighted in qualified accounts because when you look back in the 70s and the 80s and, after all of these, ERISA created all of these retirement accounts and IRAs and all of those kind of things, it made a whole lot of sense. And the thinking was, go with a tax deferred account because you're going to end up better off down the road. And the assumptions were you're in a higher tax bracket right now than you will be in retirement because, and I don't necessarily follow the thinking that your expenses are going to be 15% lower in retirement than what they are when you were working, because there's very, very few times when somebody retired and said, I made $80,000 last year and I only need $60,000 next year. It's usually doesn't quite work that way. But the assumptions in the financial planning community were always that you're going to be in a lower tax bracket in the future in retirement. So why not save the money on taxes right now and pay the taxes later when you're in retirement? Well, if you followed that strategy, it probably worked out pretty good for you because you were in a higher tax bracket than you are now. So if you're in retirement, and even if your expenses didn't decrease, the tax brackets did. So this is a window of opportunity, and I know a lot of partners have been following that, where they're moving money out of their IRA accounts because it's tax deferred. I prefer the terms tax delayed or tax postponed because we never did get out of paying those taxes. We just kick the can down the road. And if you're not taking advantage of these lower tax rates right now, you're kicking the can down to your kids. So do you want your kids or your uncle to inherit the majority of the money that's in your IRA account? And when I say your uncle, of course, I'm talking about your Uncle Sam, not the uncle that you may love, but the uncle that you did not want to include in your estate plan. So to tie this into what's happening in the markets, if you're doing a strategy where you're moving either money from your IRA to a Roth account or an IRA to a non-qualified account, just like an investment account, now's a really good time to do it because you probably have some stocks that are in your IRA account that are down in value. If you're properly diversified, I'm sure that you do. More than 1/4 of NASDAQ 100 stocks are now down more than 50% from their highs. Now, if you've owned these stocks for 5 or 10 years, you're probably still net up in the position. But if you look at where they were, a year ago or even 6 months ago, they're probably down quite a bit. So if you're not going to spend the money that you're moving out of your IRA, most places that you have your IRA, you can do what's called an in-kind distribution. And you can either move it to your Roth account or to your non-qualified account. Now, either way you go, you're going to pay taxes on the money. So you want to make sure that you take care of that and account for that and have some money sent to the IRS ahead of time. You don't want to end up owing, getting in a position with your taxes where you owe a lot more than what you had planned on and maybe get a tax penalty. So you want to do some withholdings if you're going to do that. But you can take those stocks that are down, and you can move them out because you're only going to pay taxes on what the value is on the day that you move them. So if you have a $10,000 stock position that's only worth 5,000, let's just say, and you move that stock from your IRA either to your Roth or to your non-qualified account, well, you're only going to pay tax on the value on the day that it moves. So on a $10,000 position, you're only paying $5,000 worth of tax, not $5,000 in tax, but on $5,000. So then you move it out, and if you've moved it to a Roth and the laws stay the same, well, you're never going to have to, it's likely, depending on what stock it is, it's very likely that it will recover. And so if it recovers in the Roth or the other account, then you're going to be in a position where you didn't have to pay taxes on, that additional gain. Now, you may have to pay capital gains tax if it's in the other kind of account. But either way, now's a good time to take a look at those things and see what you can do to help preserve some of your portfolio from taxes.
Hey, remember to click the subscribe button right here on the screen. And don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.tv. That's FISM.tv.